What's up, YouTube? It's about my, fourth video. Views are slow, but it'll happen, right? Trust the process. Anyway, thank you for watching The Broke Investor. Again, a channel for people that are a little less fortunate than most, live paycheck to paycheck, but want to get rich someday, or at least have financial freedom. I'm not there, but I plan to be, and I would like to share my journey. So that's what this channel's about. If that's not of interest, tune out. If it is, stay aboard. Hit subscribe, click that bell notification, the whole nine, the whole spiel that you hear over and over. Anyway, today I just want to maybe go over something that people are curious of, and I'll say the basic and more important terms that you need to know when you're involved with dividend growth investing. So anyway, as far as broke investors, I'm assuming the majority of you are using Robinhood or whatever the free apps are, but I'll just use Robinhood as an example. Robinhood is a great basic app, and it does list most of the information that you need to invest in a stock, but I'll go over the terms that are listed there for now. So when you pull up a stock in Robinhood, and you scroll towards the bottom, you'll see a little about 10 items with ratios and amounts, but one of the obvious important terms is dividend yield, and that's basically the percentage of the amount of the dividend that it's paying based on the current stock price. So most dividends pay out quarterly, some monthly, but regardless, they take whatever it comes to for the year divided by the stock price, and that's the percentage for the dividend yield. A good starting yield is around 2, 3, 4%. REITs, real estate investment trusts, are a little higher because they're required to pay out the majority of their income in dividends. But for the most part, the average typical stocks that you're going to look at are 2, 3, 4%, and that's it's a decent starting yield. But I'll get into yield on cost later on, but let me just finish the terms in Robinhood. They also have PE ratio, which is price to earnings ratio. It's basically comparing, the earnings versus the price of the stock. And it depends on the sector, but the average, if the PE ratio is under 20, under 15, you're most likely getting a fair value of the stock. If it's above 20, it depends on the timing too. I hate PE ratio, but a lot of people swear by it. A lot of people swear by forward PE, which is, it's not based on the current earnings, it's based on the estimated future earnings based compared to the current stock price. So again, I'm not too big on it, but it's there and it's worth glancing at. What else? Robinhood has market cap. Market cap is basically the value of the stock. So stock price times outstanding shares. Enough said. Obviously, most of Apple was the first company to hit over $1 trillion market cap, which is insane. You can't hate on Apple stock. It's just going to keep going and going and going. I guess the next question is, who's gonna hit $1 trillion next, Amazon or Microsoft? I mean, I'm assuming Amazon. They're taking over everything, but we'll see. What else? What's the other freaking terms on there? I think that's it. But anyway, going back to the dividend, the yield. I'm saying 2 to 3% is the norm. So what I was mentioning before, yield on costs, as you're looking at stocks to buy into, one thing that is appealing and is good to keep track of is how many years the stocks actually have increased their price. Increased their dividend. I know they're called like the dividend aristocrats, kings, champions, whatever, over something over 25 years. But any company that has increased their dividend for 25 years or more, you can pretty much, nothing's a guarantee, but it's safe to say that it's going to gradually, you're going to gradually keep getting raises every year. And what that means is, you purchase a stock today at a certain price, and your dividend yield is, say, 3%. If they continue to increase their dividend, a fair amount, in 10 to 20 years from now, you could be getting a yield on cost of, say, 10%, 15%. Just think about that. Because the original deposit, the amount that you put in towards that stock was X, but the dividend was 2-3% at that time. Now the dividend compared to that original price is like 10%, 15%. You're not going to see that kind of returns anywhere. Well, at least not in a bank, but you'll get those returns for just sitting there. So it's wise to invest in companies that do increase their dividend. Not only increase their dividend, but increase their dividend a fair amount. So keeping an eye on growth companies, companies that are just going to make it, through thick and thin, through the next market crash. Those are the companies that you want to look at. So that's yield on cost. One of the tools that I use to track the dividend yield, the number of years they increase their dividend, payout ratio, which I'll get into in a sec, is dividend.com. It's a pretty easy website. You just go to it, type in the stock. It covers all the basic terms you need right up front there in that one page. But anyway, next one is, and probably the most important one for dividend investors, is payout ratio. So payout ratio basically tells you how much of their earnings they're paying out to the dividend. So if you see 100%, that means their entire earnings is going towards the dividend. Not good. If you see over 100%, that means they're borrowing to pay the dividend. Not good. Debt going to keep going up. So obviously, a payout ratio under 100 is ideal. Payout ratio under 70%, I say, is great. It's also, again, depending on the yield too. I know if you look at like Visa, for example, their yield is horrible. Their payout ratio is very low, though. So much room for growing. So Company like that, I mean, I haven't gotten into Visa yet, but it's hard to with such a low starting yield, you know, and you're just starting out. You're just trying to reach a certain amount each month of dividend income, and you're gonna buy into something paying less than 1%. I know it's tough, but it's Visa. Where the hell are they going? I mean, they're involved with everything. So again, their payout ratio is so low that there's, you know, you can expect raises, I'm sure. So anyway, the payout ratio is key. I know I mentioned real estate investment trust REITs. Those are typically around 80-90%, but again, they're required to pay the majority of their earnings to shareholders through the form of the dividend. So I think that's it. I don't know. I wrote down the term somewhere that I was going to talk about. And the problem with making a video when you're driving is you forget everything. As soon as you hit record and you're driving, people driving slow as shit, you're, you know, stuck at lights. Forget what you're doing. But this is the Broke Investor channel. We don't have time or equipment to make videos otherwise. We have to do it on the go, right? Yeah. I mean, most people, hopefully you don't care about the video. I know me, for example, I listen to my YouTube videos on the commute, so I don't even know what the hell the video's about. I just listen to the audio. But if you're watching this and trying to enjoy the video, good luck. Sorry, this is very boring, but I'm hoping the audio is a little more exciting. Maybe in a week or so, I'll try to make a video from home, see how that works, but don't get your hopes up. Anyway, thanks for tuning in. Until next time.